All right, let's jump right in. Today, we are getting into a topic that can really be a headache for tax professionals, a client having to repay Social Security benefits. We're going to do a deep dive into the Claim of Right Doctrine and specifically how you can use Internal Revenue Code Section 1341 to get the absolute best result for your client.
So here's how we're going to tackle this. We'll break it down into 4 key parts. First, we're going to look at the legal foundation, the why behind all of this. Then we'll walk through a practical decision tree, the exact steps you'll follow. After that, we'll get into the fun part, comparing the deduction versus the credit to see which saves your client more money. And finally, we'll cover the common mistakes and compliance traps you really need to watch out for.
Okay, first things first, to really get a handle on Section 1341, you've got to understand the legal problem it was designed to fix. And it all starts with something called the Claim of Right Doctrine. You know, the basic idea here is pretty simple, and it's tied to our annual accounting system. The IRS's position is, if you get some money and it looks and feels like it's yours to do whatever you want with, you have to report it as income in that year. Now, you can probably see the problem this creates, right? What happens if a few years down the road, you find out you have to give that money back? You've already paid the tax on it. And believe it or not, this is not some newfangled rule. The Supreme Court laid this all out way back in 1932 in the famous North American Oil case. The court's message was clear. You report the income when you get it, and you worry about any repayments later. And that decision is what set the stage for this tax inequity that Congress eventually had to step in and fix.
That inequity really came into sharp focus in 1951 with another case, U.S. v. Lewis. Here, the court said a taxpayer who had to repay a bonus could only deduct it in the year he paid it back. He couldn't go back and amend the old return. Now, just think about that. Imagine you got the money when you were in a 35% tax bracket, but you repaid it when you're only in a 15% bracket. That deduction is worth way less than the tax you originally paid. Congress saw that this just wasn't fair, and only 3 years later, they passed Section 1341 to provide a direct fix.
So this is absolutely crucial. Not every single repayment is going to qualify. To get the powerful benefits of Section 1341, your client's situation has to hit 3 specific conditions. There's no wiggle room here. First, it had to have appeared they had a right to the money. Second, the repayment itself has to be a deductible expense. And third, and this is a big one, the amount has to be more than $3,000. Okay, so we've got the theory down. Now let's make this real. When a client walks in with an SSA 199 that shows a repayment, here's the decision-making process you need to follow.
The very first fork in the road is all about timing. Was the overpayment received and then paid back all within the same tax year? Or are we dealing with a repayment of benefits they got in a previous year? The answer to that one question sends you down 2 totally different roads. Now, if you get lucky and the benefits are repaid in the same year they were received, things are incredibly simple. The Social Security Administration basically does the work for you. On the SSA 1099, they'll show the gross benefits in box 3, the repayment in box 4, and your client just reports the net amount from box 5. This is all handled under a different rule, IRC Section 86 D2A. It's just a simple netting, and Section 1341 is completely off the table. But of course, it's not always that easy, is it? For the much more common situation, a prior year repayment, your entire analysis hinges on one magic number. Is the deductible amount of that repayment greater than $3,000? This is the bright line test. $3,000. It is an absolute all-or-nothing threshold. If the repayment is $3,000 or less, you follow one set of rules. If it's a penny more, just $3,001, you unlock all the powerful options we have under Section 1341. So here's the whole decision matrix in one place. Current year, simple netting. Prior year, over $3,000, we get that great choice under Section 1341. But I really want you to look at that middle row. For repayments of $3,000 or less, right now, because miscellaneous itemized deductions are suspended by the Tax Cuts and Jobs Act, your client gets 0 tax benefit, nothing. That is a huge trap you have to be aware of. All right, so your client made it over the $3,000 hurdle. We've confirmed Section 1341 applies. Now comes the interesting part. The law gives us a choice between 2 different ways to get relief, and it's our job as pros to figure out which method saves our client the most cash. Okay, so you've got 2 options. Method 1 is the simple one. You just take an itemized deduction for the repayment on this year's Schedule A. Method 2 is a bit more work.
You have to go back in time, redo the tax calculation for the year they got the money, and then claim the difference as a dollar-for-dollar credit on this year's return. And there's no shortcut here. The only way to know which is better is to run the numbers both ways. Now, calculating this credit, you have to be meticulous. First, figure out this year's tax as if there's no deduction at all. Then comes the critical part. You essentially do a what-if amendment of the old return. You take out the repaid income, but you can't stop there. You have to recalculate everything that was based on AGI. Did it change their medical deduction? Other phase-outs? You have to trace every single one of those ripple effects to get the right number. And this formula really gets to the heart of what Method 2 is all about. It's designed to figure out the exact tax cost of including that income in the first place. This is what makes the taxpayer truly whole again. It gives them back the exact amount of tax that the repaid income cost them back in that prior year. So, you're probably wondering, when does the credit usually win? Well, it's often the better choice in 3 common situations. First, if tax rates were higher back then. Makes sense, right? Second, if your client's income is lower now than it was then. And third, and this is a big one to remember, if your client is now taking the standard deduction. The credit method is amazing because it lets them get the full Section 1341 benefit without needing to itemize. It's the best of both worlds.
Okay, we've gone through the logic, we've done the calculations, but that's only half the battle. Now we need to talk about the critical compliance stuff and the #1 calculation mistake that I see practitioners make all the time. Please listen up, because this is, without a doubt, the most common and the most expensive mistake you can make. See, unlike a salary, Social Security benefits are usually only partially taxable. The relief you can claim under Section 1341 is based only on the part of the repayment that was actually taxed in the first place, not the gross amount your client paid back. You have to go back and figure out what that taxable portion was. And don't forget, even for your highest income clients, the absolute maximum portion of Social Security benefits that can ever be taxed is capped at 85%. So what does that mean? It means for those clients, the amount you use for the Section 1341 calculation will always be less than the gross repayment number you see in Box 4 of that SSA 1099. The IRS isn't messing around with documentation on this one. The Internal Revenue Manual is crystal clear. You have to attach 3 things to the tax return: proof the money was actually paid back, proof there was a legal obligation to repay it, it can't be voluntary, and proof that the income was actually reported on a prior year's return. If you skip these attachments, you're just asking for the claim to get kicked back. And let's wrap this up with one final, very important thought. You have to remember the spirit of this law. The whole idea of the claim of right rests on the taxpayer having a legitimate, good faith appearance of a right to that money. As the court made perfectly clear in the Parks case, you can't create that appearance through fraud. Section 1341 is a remedy for honest mistakes, not a loophole for intentional wrongdoing. And keeping that in mind is fundamental to getting this right.